Hello, and welcome to the latest Insights Live Preparing for Retirement. I'm Susie Allen, Vice President of Insights from Fidelity Wealth Management. This is the first in our three-part series on preparing for and living in retirement, where we'll address important questions you may face along your retirement journey. Retirement is a key component of Fidelity's comprehensive planning. Last month we covered taxes, and next month we'll focus on estate planning. But let's talk about today, a little roadmap for you. We will talk about many of the considerations and decisions you face as you start to prepare for this transition to retirement. We'll talk about how to understand what your expenses will look like post-retirement, then how to assess your level of savings. After that, we'll discuss building an income plan, Roth conversions, and what retirement means for your investment strategy. But before we get going, I want to let you know Fidelity does not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we are providing is going to be general in nature, and it may not apply to your situation. But if you do have legal or tax questions about your specific situation, we encourage you to talk to your attorney or tax professional. All right, that said, let's introduce this amazing team of professionals from Fidelity who are here with us today. I'll ask everyone to introduce themselves and briefly describe their role at Fidelity and the perspective they bring to this discussion. So Michelle, let's start with you.
Thanks, Susie. I'm a financial consultant and certified financial planning practitioner here in Edina, Minnesota. I've worked for over 20 years collaborating with savers to create wealth planning strategies that cultivate successful financial outcomes for my clients and their families.
All right, welcome, Michelle. Justin.
Hi, I'm Justin Bailey. My role is I'm a regional vice president for our planning solutions. In my role, I support financial consultants with Fidelity in retirement income planning, investment planning, and tax planning. I have worked for Fidelity for over 28 years, and I'm also a certified financial planner practitioner.
Amazing, 28 years. Welcome, Justin. And Rita.
Hi, I'm Rita. I am a vice president overseeing our Fidelity's retail retirement products, and we try to help clients of all ages with their retirement journey from getting started, saving, transitioning, and living in retirement.
All right, thank you, Rita. Welcome, everyone. So let's start with a popular question among clients who are approaching retirement age. How do you determine how much money someone needs to have saved in order to retire? Michelle.
Well, first, Susie, I'd really like to start by dispelling a common retirement myth that there is no magic number. There's no universal savings amount that we each need to save. Financial planning is really not one size fits all. It's really personal to you and your family. As a starting point, you'll need to estimate your retirement expenses. We can use your annual cash flow statements from banks and credit cards, or perhaps look at your current take-home pay as a starting point and build from there. Once we've got that good baseline, you can do the fun part, which is to envision all the other things you'd like to pursue when you're in retirement. In retirement, you should expect to spend about 55 to 80% of your pre-retirement income. And that's a broad range. The variables are healthcare costs and your lifestyle, and that will lend a lot of influence to these numbers. So as an example, I'll share with you that I worked with a 57-year-old single woman who'd accumulated $6 million toward her retirement goal. By the time we actually mapped out the cost of her 3 properties, associated property taxes and insurances, the boat storage, and all the other expenses associated with her lifestyle, I had to deliver the tough message that she'd need to either work longer, save more, or perhaps reduce her expenses. Conversely, though, I've worked with lots of clients who also have smaller nest eggs, lower retirement expenses, who have successful plans and no major modifications in their lifestyle and expenses. They too are having lots of fun in retirement.
Right. Great examples and really speaks to the level of personalization needed here. Wondering, how does spending typically change over a long retirement?
Yeah, that's a great question. It does change because we're all going to be a little bit different, but typically when we look at a 30-year period of time for retirement, we typically see people adjust their spending throughout the whole 30 years, but really in kind of three parts. And let me just break this down. Typically in the first 10 years, so let's say I retired at 60, from 60 to 70, that 10 years, we call it the go-go years. Why do we call it the go-go years? Because now I have freedom, I have time, I have some resources. So maybe I have a big bucket list. I want to go to Europe 5, 6 times. I want to be on a beach half of that time. I want to remodel the bathroom, like all this pent up energy and demand. And we have the time and are physically feeling pretty good. So we're going to start knocking a lot of those things out, which typically means my spending might be higher. But what happens after that bucket list has maybe been worked through, or a lot of it, now I'm in my 70s, and we'll just call this the next 10 years. I call it the slow go years. I've been to Europe 5 times. I have a t-shirt every time. Do I really need to go see the Eiffel Tower a 5th or 6th time? So I'm slowing down. Maybe I'm going to stay more closer to my community. So I'm not going to spend as much maybe on travel and other things. And so we actually see spending start to decrease, actually, as those demands or what I'm really interested in starts to slow. Also, maybe some of those aches and pains, making it hard to be on a plane for 8 hours, makes it a little harder too. So we're going to see a little bit of a slowdown of spending, usually in our 70s. But then we get to what I call the no-go years. And this is the last 10 years plus of retirement. Actually, spending increases. Why? Not because I'm going to run out and do a lot of things, but because my healthcare costs. So I'm having more therapeutics, more maybe medicines, maybe more visits to the doctor, maybe a hip replacement because I finally needed it. And you tend to be a little bit more homebound, but at the same time, those costs have gone up. My own personal experience, my mother, she of course went through COVID. She's actually in her late 80s. She's now on oxygen full time. So she's homebound, but even though she's not out spending, there's a big, massive oxygen unit that's helping her feed oxygen, and that's not cheap, right? And even though medical costs offset some of that's coming out of pocket. So think about it as my first 10 years is the go-goes, my middle 10 is the slow go, and then my last 10 plus will be my no-go years.
All right, awesome, Justin. Hope your mom is doing well. Go, go, slow go, no go. We expect to see lots of t-shirts in your background soon. All right, how can someone start creating a plan to cover all their potential expenses in retirement, speaking of?
Well, Michelle and Justin actually just touched upon this a bit. So as you look at your expenses, take a look at your current bills, your lifestyle, what are sort of must-haves that you want, and what's the lifestyle you want to live. And obviously, those expenses will change through your retirement phase. But try to do your best, put them down on paper, and then look at your income sources. You'll want to take a look at any income you might have from part-time work, even if you're retired. That is something that a lot of people do for leisure, for fun, for social connection, portfolio income that you might get, dividends and interest, rental income, Social Security, as well as any distributions from 401ks and IRAs. And then the first thing you'll want to do after that is just make sure you identify your day-to-day expenses. Those are non-negotiables like housing, food, taxes, utilities. You want to make sure that that will be covered through what we call guaranteed income sources. And what we mean by guaranteed income sources are usually Social Security, pensions, and income annuities. Social Security is probably going to be your most common predictable income source right now for retirees. Pensions, less so these days as companies have moved towards 401k type plans. But income annuities are another one that is a common source and continues to grow. These are essentially contracts by insurance companies that, in return for an upfront investment, guarantees to pay you a set amount for a set amount of time. And so after you take a look at your non-negotiables and making sure that those are covered, you want to look at your discretionary expenses. So anything like, hey, I'm going to Europe for the 6th time, one-upping Justin there, you'll want to make sure that those discretionary expenses are covered by distributions from like your savings and investments accounts. And the reason for that is because if something would occur, if there was a market downturn or economic downturn, you can actually pull back without hurting your day-to-day. And then once you do that comparison, you'll want to see between your expenses and income sources whether there's any sort of gap and how you might then try to fill it.
All right, well, that leads to a great follow-up question. What if there is a gap between your estimated expenses and your projected income?
Yeah, well, most folks find that once they stop working, their regular income, like Social Security or pensions, don't quite cover all their expenses, especially if you're retiring early, right? And you strategically are waiting to claim these other income sources at a later age. That gap between income and expenses is really normal. Most people do see that as part of their retirement plan, but it is something that we can help you plan for. At Fidelity, we believe the most successful financial plans utilize a diversified income approach that combines growth, guarantees, and flexibility. We also believe that your essential expenses or your non-negotiables, as Rita mentioned, should be covered by predictable income sources like Social Security, pensions if you have them, as well as income annuities. The first thing you'll want to do is define the amount of the income gap and its duration. Does the gap exist just until pensions and other income sources start? Is the gap permanent? The length of the gap will help us determine ways to make up the difference in your spending. And some common techniques to solve this gap include an unprotected withdrawal plan, an income replacement strategy, or a bridge strategy. An unprotected withdrawal plan is one where we create a recurring withdrawal on your account to distribute a specific dollar amount. This option is called unprotected because there's really no guarantee that volatile markets won't cause you to run out of money. Though the benefit of this strategy is it's really flexible, right? So you can increase or decrease the distribution as needed to also adjust for market fluctuation. One of the dangers of this approach is sequence of return risk, which is that the timing of your withdrawals and market returns will impact your experience. The slide we're looking at is a hypothetical example of two retirees, Susan and Robert. They have the same average return throughout their retirement. They have the same withdrawal rates at the onset of their retirement and the same portfolio starting values. The difference is that the sequence of market returns against their withdrawals impacts the future of their asset base. As you can see, the same strategy can harbor vastly different results. The chart highlights the growth of Susan's portfolio because she's taking withdrawals against positive performing years in the market, while Robert is taking the same withdrawal rate initially, but he's taking it against a backdrop of volatile markets. So to illustrate that further, as an example, if you're hiking up a mountain and you stumble, the risk is really less than if you were to fall while you were coming down that same mountain.
All right, Michelle, super helpful illustrative examples there. You mentioned a couple of other strategies, so let's walk through those.
Yeah. So an income or salary replacement strategy is an approach where we fill in the gap between your expenses and your income with a more permanent and guaranteed solution like an income annuity. Think about how you were paid when you were working, right? Most people become accustomed to the regularity of a salary. So in retirement, people often like to replicate that approach, and you can do so with a combination of annuities and other types of predictable income sources. That combination can help limit or possibly even remove market risk from your income approach. Lastly, a bridge strategy solves a more temporary income need, and this usually presents itself at the onset of your retirement. For example, if you were to retire at 62, many people might wait to claim Social Security at their full retirement age of 67 years of age. And so a bridge strategy would allow us to create a temporary income stream, like using a period certain annuity, which pays out over a set number of years versus a lifetime, a bond or a CD ladder, or perhaps we maintain some funds in more of a reserve bucket that can be spent down over a short number of years to solve that gap. Either way, there are a lot of techniques a financial professional can use to help build out a strategy that's really specific to your situation and your preferences as an investor. It's really also important to note that some of these combinations, some of these strategies could be used in combination with one another. So none of them are really mutually exclusive either, Susie.
All right, Michelle, thank you for walking us through those strategies. Now, Justin, is there a yearly withdrawal percentage that can be considered safe?
Yeah, I think this is talked about quite a bit in the industry, and I think a lot of people have heard of a thing called a 4% rule. So let me just take a moment and just explain what that was or what it is. 30 years ago, there was research published in the Journal of Financial Planning that actually said, hey, if we back tested from 1926 all the way at this point was the early 90s, 30 years ago, we back tested a balanced portfolio, half in stock, half in bonds and cash, and they started a withdrawal rate. So if you see on this chart here, we go all the way back to 1926, you'll see there, if I did a balanced portfolio in 1926, I could withdraw 8% at that time. And at that time, the mortality was about 28 years in retirement, not 30 plus. But I could have lasted and my money didn't run out. So you can see where all these blue bars are. Those are all the starting withdrawal rates of my 28-year period of time that it would have been sustainable. You'll notice the bars are high until we get kind of in the 60s, and then they drop there, and that's where that big green line crosses, where that 4% came from. Because how this methodology works is if I take basically 4% of my original starting balance, let's say I retired today, I have $1 million, 4% of $1 million is $40,000 a year. If I start to withdraw the 40,000, I only calculate that once, actually, and I adjust that 40,000 withdrawal based on inflation. The reason why you see it drop there in the 60s is because what happened in the 70s? Inflation, a lot of inflation. And that's why we started to look at this 4%. So that's where the research ultimately came from. And that's where a lot of people are thinking, okay, I'll just follow a 4% rule. Now I'm going to be I did the quotations with rule on purpose because I would call it a rule of thumb. It's a good starting point. There's been research since, some advocating that the 4% is too conservative and that we should be able to withdraw a higher amount. There's other research that says that it's actually too optimistic and we should actually drop it down. For example, some of those proponents that say, hey, we should be able to withdraw 5% or more, because the criticism of that original research was they only used large caps and treasury bonds as the proxy portfolio. They didn't include mid caps and small caps. They didn't include international stocks, let alone on the bond side. There was no corporates, high yield, maybe some emerging market debt, foreign debt. So we have all these other classes, other asset classes that do help boost returns or can help improve the portfolio if we're diversified. We don't want to take on additional risk that we're not comfortable with, but it can boost those overall returns. So maybe it is possible that we can withdraw more. On the other side, there's also been another debate about, well, what happens if we have prolonged low interest rates, for example? So from 1926 to the early 90s, we did have some lower interest rates in the 40s, but it wasn't as low and as long as what we just went through. So most of us on this webinar know that the great financial crisis in 2009, interest rates basically went to zero, and they stayed at zero for most of that period of time up until about 2022. And we all know it because our money markets were barely earning anything. Our bank accounts were barely earning. So what happens if half the portfolio is underperforming historical averages of return? So with that research, it would suggest, well, maybe we should be closer to a 3% withdrawal. Okay, I just said a lot there. And I know that. So what does this all mean, Justin? What's the withdrawal rate? Here's what I would say. It is a good start. A 4% withdrawal is a good start. But as Michelle and Rita have said, honestly, this is customized to you. Ideally, if we align our portfolio withdrawals to help pay for the discretionary items in our budget, while the essentials are covered by the more predictable sources of income, then I have some flexibility. Maybe if the market does well, I'll withdraw 5%, maybe 6%, and it'll be okay. But if the markets don't do well and cooperate, I can maybe drop it because it's discretionary. It gives you control, is what we're ultimately after. So that's where I would see as the safe withdrawal. So just be careful. It's a great starting point, but let's customize to you.
All right, Justin, I appreciate that rule of thumb and the rhetorical question. You're doing my job for me, asking to summarize there. So it's great. All right, well, you did talk about inflation a bit. So, how can someone account for the possibility of increased inflation?
So inflation has been a conversation point in nearly every meeting for us over the last several years. Let's start with the foundation of asset class returns, just as a baseline for this question. Historically, over the last 35 years, cash has returned around 3%. Bonds have returned around 5%, and stocks have returned just over 10%. So if inflation is running at 3%, it really does underscore the importance of considering some stock exposure as part of your strategy to help you maintain your purchasing power over time, even for the most conservative investors. In addition to your asset allocation, you may also want to consider your sub-asset class investments. That is to say, what types of stocks and what types of bonds do you own? So certain investments are designed to combat inflation better or designed to adjust for inflation risk. And so those investments would be Treasury inflation protected securities, real estate investment trusts, commodity exposures, international stocks, dividend growth stocks. So if you're concerned about inflation risk in your situation, you'd want to talk with your financial professional about ways to incorporate some of those types of investments into your portfolio strategy. Lastly, thinking about your income strategy, you also want to consider ways to help lower inflation risk against your cash flow strategy. So Social Security is subject to inflation adjustments over time. And if you are fortunate to have a pension, remember private pensions typically don't carry inflation adjustments. Public pensions may have an inflation adjustment, but one of the other benefits of annuity strategies is that you can actually include specific features based on the specifics of your situation. So many annuities can actually be structured with an optional feature, which is called a cost of living adjustment, so that your annuity income increases over time.
Awesome, Michelle. I know that's on clients' minds right now, so appreciate the input there. So let's talk more about retirement income. At age 73, most of us will need to start taking required minimum distributions, or RMDs, from tax-deferred retirement accounts. So what are some high-level things people may want to keep in mind about planning for RMDs?
Oh yes, RMDs are one of my favorite topics. So RMDs are required from tax-deferred retirement accounts. What this means are accounts like traditional rollover IRAs, as well as workplace retirement plans such as 401ks and 403bs. And basically, when you contributed to these plans, they reduced your annual income and you didn't have to pay any tax on the earnings growth. However, at age 73, you are now required to take distributions from those accounts where you will have to pay income tax on those withdrawals. This is different from Roth IRAs where you sort of, when you contribute, you are taxed upfront, and then provided you meet certain conditions, you can take advantage of tax-free distributions down the line. With RMDs, there is a yearly deadline that is December 31st, unless it's your first RMD, in which case you do have the one-time option of delaying that first RMD into the following year, April of the following year, where you turn 74. Most people ask, well, do I need to calculate my RMD? Well, most financial providers will provide it for you, provided that they had your balance on the last day of the year, 12/31. That's a fun fact. We all have a great party on 12/31, not just for New Year's, but for RMD calculations. If for some reason it is not calculated for you, there's tons of resources out there, but it's actually pretty simple to figure out your RMD calculation. What you do is you take the account balance on the previous year, 12/31 of the previous year, and divide it by your IRS life expectancy factor. This is based on your age. So if we take an example, let's say you had $100,000 in a tax-deferred retirement account on 12/31, and let's say you were 74. Your life expectancy factor would be 25.5. So if you just divide $100,000 by 25.5, you would get an RMD of approximately $3,921. And so the thing to remember with RMDs, and this is what catches people off track, is that they are taxed as ordinary income, but it also counts towards your total taxable income for the year, which means you're subject to federal taxes and possibly state taxes. And for a lot of people, they get caught off guard by the fact that these distributions, as well as other income that they may have, push them into a higher tax bracket, which seems a little disbelieving for some people, thinking that they might be in a higher tax bracket in retirement than they are like when they're actually working. And this is important in retirement because it could impact being in a higher tax bracket or increasing your taxable income can impact certain benefits like Social Security and Medicare.
Yeah, I think that's a really important part to underscore, so don't get caught off guard. Appreciate that, Rita. And also, it sounds like you're calculating RMDs on New Year's Eve, so something else to consider there. All right, sticking with the topic of retirement accounts, we get a lot of questions about converting traditional IRAs to Roths. So let's unpack this to level set. What does it mean to do a Roth conversion?
Yeah, I mean, a Roth conversion allows you to essentially take a tax deferred retirement account and moving it into a Roth IRA or Roth 401k. And what happens is you'll usually need to pay any taxes on your converted amount, and that converted amount counts as your taxable income in the year the conversion is completed. And so many consider doing a Roth conversion because it allows you to take advantage of Roth benefits. So, like I mentioned just a couple minutes earlier, the potential for tax-free withdrawals, provided certain conditions are met. Second is no RMDs. So that's one big benefit. And then lastly, tax diversification. So if you have still a bucket of tax deferred dollars in your tax deferred accounts, and then this bucket in Roth, you're able to better manage your tax bracket in retirement by using withdrawals from each to help manage that.
All right, thanks, Rita. We'll let you off the hot seat for a moment here. Why might someone want to consider a Roth conversion?
Yeah, I get this question all the time, Justin, should I just move it all to a Roth? And because it's tax-free, it's growth. And yes, but let's be a little careful on this. So think about it this way, and Rita mentioned it, right? Our 401ks and our IRAs are probably some of our biggest savings vehicles that we have, besides our homes generally, right? And so they get big, and after 30 years, 40 years of contributing and growing, they do get pretty sizable. And then eventually RMD shows up, at age 73, and then we're going to have to start withdrawing money out, and it can put us up into higher brackets. So I like to call this pre-tax money is like a balloon. It just gets bigger and bigger, and we want it to get big because that's the whole point: grow, build our wealth, but it can put you into a higher bracket. So one consideration before we just go and try to move that all into a Roth, first of all, that would be a massive tax. And so we don't want to do that. We want to be a little smarter. What I'd like to suggest to most people is, once I retire and I don't have my salary, my paycheck coming in, that's maybe I have to already claim taxes on. We call it kind of an income valley, where it's between I just retired, so I don't have the paycheck anymore, but also maybe in 10 years, I'm going to have the RMD. So this little valley of opportunity, maybe I can piecemeal Roth conversions there because I'm in a lower bracket and I can just bring them over slowly over time. What that does is I call it let the air out of the balloon a little bit. Because the one key thing about Roth, it's really only tax-free once I've recouped the taxes from the conversion itself. So there's two aspects of that. One, we want to make sure if I'm converting, I would always suggest pay the taxes out of your own pocket, not from decreasing the amount of the conversion and trying to do it from your IRA, because then it's harder to recoup, right? So be prepared to pay out of pocket. Number two, do I have time? I don't need this money. If you came to me and said, well, I'll convert it to a Roth and then I'm going to go buy a boat in 5 years, pointless. Shouldn't do it. What we should do is convert it, pay the money out of our pocket, and then let it grow. Usually a minimum, I suggest just to make sure that growth takes place, is at least 8 to 10 years to really let the market grow, recoup all those taxes that I just fronted up. And now I'm really running forward. Also think about this as what do you want to give to your heirs they'll probably get some of the assets, right? Maybe, home, other things that maybe I get a stepped up basis on. But on the IRAs, when they receive that, they will have to pay taxes over for non-spouse beneficiary unless they're eligible for an exception. But most are going to have to pay that out over 10 years. So think about the tax consequence of a major IRA asset over 10 years. Roth, tax-free. So just two things to take away from this. Number one, let's take advantage of where we are in our tax brackets at certain periods of time, usually in our 60s are ideal. And let's piecemeal it over. Let's not do massive amounts all at one time and drive those taxes up, harder to recoup. Let's do it slowly over time.
All right, that's helpful, Justin. I know we have some great tools here at Fidelity. So there's a Roth conversion calculator, and we can flash that on the screen for everybody as well. All right, let's talk about early retirement. We know that some of our clients hope to retire before the traditional retirement age. Maybe they're going to go to France for the 7th time and one up both Justin and Rita. So what are some considerations in determining if that's a possibility?
Yes, Susie. So, retiring early has its own set of risks. And those risks are really largely underpinned by the fact that you're just going to spend a much longer time frame in retirement. By far, the biggest thing to consider is healthcare costs. If you plan to retire prior to Medicare eligibility at age 65, you're exposed to the cost of private medical insurance. And that cost, while it can vary based on your state and your income, it ranges between $500 to $1,200 per month per person. This doesn't include copays, deductibles, prescription costs, which really only add to the expense. So to address that cost, I want you to think about saving as aggressively as you can. Our mantra at Fidelity is to save early and save often when you first start making money. Secondarily, don't underestimate the power of health savings account assets. So remember, those are triple tax advantaged savings accounts. You get a tax deduction up front, those dollars grow tax deferred, and if they're used for qualified medical expenses, you can distribute those assets tax-free. So if you have a high deductible plan, consider building this account balance as much as you can for use in retirement. Remember, in 2025, the contribution limit for an individual is $4,300. For families, $8,550. And if you're 55 years and older, the catch-up contribution is an additional $1,000. Another consideration is that retirement accounts like IRAs, 401ks, 403bs, they really can only be accessed prior to the age of 59 and a half in certain situations. So perhaps you also want to rethink your saving strategy to include non-retirement accounts or other brokerage accounts so that you can access those dollars at earlier ages. Lastly, I'd just say be flexible, right? There are a number of ways that you can step away from full-time work and still retire early or enjoy a phased retirement. Increasingly, I'm working with a number of clients who have the ability to reduce their hours of work while remaining benefit eligible with their employers. If you're married, perhaps a technique to consider is having a staggered transition plan where one person retires early and the other person carries medical benefits and retires and joins that retirement party a few years down the road.
Those are great considerations. One other question here. What about claiming Social Security earlier?
Yeah, I mean, you can claim Social Security as early as age 62, but the risk there is that your monthly payments will be reduced. You might be locking in a permanent reduction in monthly benefits than when you would if you claimed at your full retirement age, your FRA. Your FRA is the age at which you're entitled to your full benefits. And right now, for anyone born in 1960 or later, the FRA is 67. And, the old adage, and it still holds true, is if you are able to delay your Social Security, you can get permanent increased payments with benefits increasing up to age 70. But there is a little known strategy where you're able to claim early if needed. But if you suspend and then restart, you may not lock in that permanent reduction. So how it would work is that you claim before your FRA, You then suspend your benefit sometime between your FRA and age 70. And after you suspend, you're actually adding retirement credits each month. So once you start recollecting, you'll actually have a higher benefit. So it is a strategy. It is a little tricky though, so it is something you want to talk through with a financial provider just to make sure you don't make any mistakes.
Very helpful, Rita. Now, regardless of what age you're hoping to leave the workforce, how should someone adjust their asset allocation as they get closer to retirement?
Yeah, this is something that we should be paying attention to as we get closer to retirement. First of all, always have an emergency fund. I'll always advocate for that so that we don't grab in and in an event of emergency, grab and have to take money out of an investment that is more for retirement. So always make sure you have an emergency fund. And then of course, as we're getting closer, so maybe we're 3 years away, 5 years away, 7 years away, we've hopefully been pro growth since, I don't know, age 25. Now we're in our 50s and we've been investing in that growth over time. And maybe we've had a higher tolerance for risk because we know it's going to go up and down, but we know it's for the distant future. But now the light is at the end of the tunnel, right? It's coming at us. This is when we need to start balancing things out. So typically when we're growth oriented, we're going to be heavier in stocks. We all know that stocks are going to be more volatile in the short term, but hopefully that volatility keeps on going up and up and up over time. However, when I'm getting close to retirement and I'm going to have to start to withdraw that money, Michelle touched on it. We don't want to be between Robert and Susan, where I have a higher growth, heavier, volatile portfolio. Now I start to withdraw and I withdraw on a negative market. That could be really challenging. So we want to balance that and maybe dial down the stocks a little bit more. At the same time, I've had some people, okay, so you're saying go all the way to bonds, go all the way to CDs. No, that's also not correct because we still got to plan for 30 plus years of withdrawals and 30 plus years of growth to keep us ahead of inflation. So ultimately what we would suggest, and again, we customize this for everybody. So we need to sit down, talk through your risk tolerance, what you're comfortable with, what we really need this to do. If I have a bridge already in place, maybe I can stay more aggressive. But at the end of the day, ideally, we probably want to balance it and bring some of the stocks down, bring some bonds in for some stability, but yet still have that exposure to stocks for the overall growth to address inflation long term.
All right, you alluded to some volatility, and clients are thinking about market volatility, which can be a potential risk to your retirement plan. So what if the market does crash just before retirement?
Yeah, Susie, this is, I think, everyone's main fear as they're approaching their retirement plan. And what I would share with you is the foundation of financial planning is really about risk management. If we've done our work well, we've planned for that scenario, and though it's uncomfortable, your plan shouldn't be upended. Ideally, you'll have a flush emergency fund, as Justin just mentioned. You've got a strategy for your monthly cash flows, and you also have a strong process to rebalance your investment portfolio despite volatility. If those strategies are in place, market contractions won't be as jarring, and you'll still be in control of your plan, allowing time in the market to recover the portfolio values. If you're not confident about your situation, please do reach out to us for support because we're really good at meeting you where you're at. I think back to a couple I worked with in 2008. You'll recall markets were down almost 40% that year. And mid-year, I began working with these folks, and they started the year with $1 million in their portfolio strategy. At the time, they were bridging to Social Security elections, so they were taking about 4% or $40,000 from their portfolio at the onset of 2008. And by the end of 2008, they were approaching a withdrawal rate that was almost 7% because of volatility in the markets. So we had discussions around spending less, perhaps starting Social Security prior to their full retirement age, or augmenting their cash flows with part-time work to try to reduce their withdrawal rates to allow for their portfolio to recover faster. Despite the couple having to make some tough choices, right? We were still able to provide many options, and they chose ultimately the best adjustment for them at the time.
All right, appreciate that example, and it certainly helps illustrate the point. We know healthcare costs are another risk or consideration. So, what are some strategies to help manage retirement healthcare expenses?
Yeah, just think about this stat, and we track this with the retirees that we work with. Your average retiree, one person, age 65, what they can look forward to for the next 20, 30 years is about $172,000 of medical out-of-pocket expenses over that time. Now, the good news, we don't have to pay that all at one time, right? That's going to be spread out hopefully over 30 years, but it's going to be part of the budget. And so, Michelle touched on this a little bit. The HSA, I would really, that's the health savings account, usually associated with a high deductible plan so that you're eligible for it. But really, we should be maximizing that and maximizing those limits. And in 2026, she mentioned what they are this year, but in 2026, if I'm an individual just covering myself, it's about $4,400 that I can put into that account. If I'm a family plan, I can put $8,750. So think about this, $8,750. My wife, my kids, if I were to max that out, just remember one thing, I am going to spend some medical costs this year. So I'll always look at my previous year and what we spend. And let's say it's $4,000 is what we spend as a family. I'm going to allocate out of that $8,750, $4,000 of it stay in cash within the account because I'm going to draw on that, pay for our medicines, our doctor's visits, so forth. But the other amount can be invested. Most HSA plans do offer different mutual fund and growth options within it. So definitely make sure that you're allocating a portion so that that can grow over time. And I want to re-emphasize why there is no other account really that has 3 tax benefits. Number one, your contribution's tax deductible. So I don't have to pay tax going in. Number two, it can grow tax without paying taxes along the way. So all the growth, the interest, the dividends, I'm not paying tax. And if it's used for qualified medical costs and premiums, it comes out tax-free. So it goes in tax deductible, comes out tax-free. It's amazing. So we should really be maximizing that. One other thing, by the way, some of us maybe know this if we're 65 or older, but the Medicare or Medigap policy open enrollment renewals is coming in about a week and a half. And so I would suggest there's a little secret here at Fidelity, but I'm going to blow out the secret right now to everyone. We actually have a group called the Fidelity Medicare Team. It's part of our Fidelity Medicare services that we actually help clients that are eligible for Medicare, first of all, understand what Medicare is and what it isn't, and then where the Medigap policy is going to come in. There's several different versions, so it's always good to get some good advice. But I would really encourage you, if you're looking at this and it's open enrollment, give them a call and just make sure that you have the coverage you need for what your particular health situation is. So that's another benefit that a lot of people don't know that Fidelity offers.
All right, Justin, since you're giving away some secrets here, let's talk about long-term care insurance. What are some of the options?
Okay, so remember I talked about the go-go, slow-go, no-go. Now we're talking no-go needs, but I need to start planning it in my go-go years, okay? So we're talking long-term care. This is a very sobering stat, so I like to share it just so that people understand. 70% of us will need some type of long-term care, right? We're going to need something. So 30% of us probably won't. We'll go quickly, I guess. So what does that mean? Well, let's review. There's 4 ways on how typically most people are going to pay for long-term care. The first one is, I call it self-pay. You're just going to pay for it out of your own pocket with your personal savings. Number 2 is we have government assistance, obviously if eligible and with certain limitations. This is where the state government, like Medicaid, can help pay for long-term care. Also, if you are a member of the military, remember you have VA services. First of all, thank you for your service. And second, make sure you're maximizing your VA services for your long-term care. So those are 2 government-assisted options. Number 3 there is our traditional long-term care. This has been around since the 60s. I think it's ebbed and flowed a little bit on cost, but what is this? Traditional is I pay a premium, I pay a monthly amount or an annual amount. And then that means that if I go into care, they generally will pay a monthly or a daily amount, like $200 a day or $250 a day. But usually they will pay like a total maximum of over $1 million or something, but it'll definitely stretch out over several years. Obviously, they're expensive, right? Because there could be a lot of coverage, and we're seeing as we have an aging population and better therapeutics that we do live longer. And so we might need that longer. The third one, or the fourth one, is the hybrid life insurance and long-term care policy. So what is this? This is where we combine life insurance with long-term care. So for example, let's say I'm one of the 30% that doesn't need care. I just quietly pass away in my sleep, and I never go into a home. I hope it goes that way, by the way. And so does that mean that when I put money into the policy, it goes up in smoke? For the traditional, it would, but for this, no, because the life insurance would kick in. So what we usually talk, whether I'm the 70% that will need care, obviously I'll get care there. If I'm the 30% that doesn't need care because it worked out, I didn't have to, you still get something out of it, more out than you put in. So it's what we call the use it or use it. No matter what, you'll get something more out than what you put in. So that's what that brings out. Now, of course, you should always be talking to your advisor. We're happy to kind of talk this through what would be helpful. But let me just leave you with two pieces here for long-term care, if I could. Number one, have a plan. I cannot tell you how many times we have an event, kids, neighbors, whoever is trying to help this individual transition into long-term care and get that. We don't know what their wishes were. We don't know where. We don't know how we're going to pay for it. And it is panic. I mean, let alone the financial, but the emotional stress on it. So let me just suggest these questions. What does a long-term care plan mean? It means who is going to help me? Where am I going to go? And how am I going to pay for it? Just those three things. Even if you're going to self-pay, at least have a plan. Just have a plan, please. It'll just take some of that emotional strain off. Number two, I will say this about the long-term care policy. We tend to lean towards that number fourth one, to the hybrid policy, mainly because we like people to use it no matter what. You should start thinking about that policy. Really, ideally, is about 55 to 65. We will still look at it, and you can access one and get one all the way up to 75, but really the 55 to 65. And I know it's not on our minds because we don't want to think about us not living our full lives, right? So we don't want to think about it, but I really encourage you. 55 to 65 is probably the ideal. And also, even if you are one of the fortunate ones who has made a fortune and have millions of dollars, I'm telling you, just knowing that there's a policy there, even though you could pay for it, write a check, but knowing a policy there that can access it and you don't have to disturb the rest of your assets should be part of a strategy that you should review.
All right, wonderful. We talked about planning for some clients who want to do some self-assessments to track their progress towards financial goals. What tools are available here at Fidelity?
We actually have a really great retirement planning experience in our Planning and Guidance Center. It's interactive, so it lets you create a really comprehensive retirement plan. You can see if you're on track with your goals. You can monitor your progress, and you can actually also explore any changes to your plan and how that impacts it. So I like to play around with it so I can see how early I can retire and what that impact might mean on my savings.
All right, thank you, Rita. I know we are running short on time, so let's get some last thoughts from everybody. Can you each share a couple of next steps for viewers? So Justin, I'll turn it to you first.
My first next step is to invite Rita over on New Year's Eve so she's not calculating our RMD calculation. So open invitation, Rita. But hey, everyone, I know it's we've covered a lot. And there's rules and some things that we need to be considerate of taxes wise and so forth. But you know what? I just live by this. If I'm not having fun, I'm doing something wrong. planning for retirement should be fun. It should be, I hope that we are just dreaming up magical things to do. And we'll partner with you and make sure we can financially do that and discuss all the pros and cons and how to approach it. Let us do a lot of that heavy lifting for you. Your job is to dream and to save, and then help us convert that into income. So just reach out to us. Let us do our part, and so that you can dream and fulfill some of those dreams.
Great, thanks, Justin. Rita, let's go to you.
Well, it's hard to top that, but don't worry, Justin. I will take you up on your offer, but I'm not calculating RMDs by hand. So that for everyone out there, feel better about that. I would echo what Justin has said. We've reviewed a lot today. We know it's a lot of information, but don't let that scare you or have fear get in the way of planning. Create that plan. Having control is really having a solid plan, and that takes account different scenarios. That'll help you feel more confident and more prepared.
Excellent. All right, Michelle.
So we've talked a lot about different circumstances impacting retirements. And what I would say is just between changing legislation, new investment strategies, cyclical market volatility, working with a planner can help you navigate all of those factors and just really put things in focus. We're not just here to help. We're really here to enhance your situation by leaning into all of our experience, Fidelity's guidance. So if you don't have a representative, please consider using our Find Advisor tool on the website, and let's sit down and have a conversation.
All right. Thank you, Michelle. I'd like to thank all of our panelists for such great insights on this topic. And as Michelle noted, if you don't have a representative, visit fidelity.com/findanadvisor. And for more timely market updates and insights on other financial planning topics, subscribe to Insights from Fidelity Wealth Management for exclusive invitations to future wealth management webinars and access to our weekly newsletter. Thank you so much for joining us.